I want you to close your eyes for a second. Imagine you're holding a crisp, brand new $100 bill.
Okay.
It represents real value. You could take it to the store, buy groceries, fill up your gas tank, whatever. It's potential energy in paper form.
I'm with you. It's a good feeling.
Now imagine taking a lighter, holding the flame to the corner of that bill, and just watching it burn. Watching the ash curl up and float away until that value is completely gone.
Please tell me you didn't actually do this for the intro.
I didn't. But in the normal world, that behavior is, well, it's insane. It's literally illegal to deface currency like that. But welcome to the Wild West of cryptocurrency.
Where destroying money isn't just legal, it's a celebrated strategic move.
It's not a bug, it's a feature.
It really is. The ultimate counterintuitive concept. And today, we're going to look at exactly why this happens. We are doing a deep dive into the mechanism known as token burning.
And honestly, looking at the research stack you send over, my first thought is just confusion. Why would anyone, a developer, an investor, a miner, want to destroy their own asset? It feels like lighting your wallet on fire.
That's the perfect question to start with. And our mission today is to unpack that logic. We need to figure out if this is a legitimate financial tool or if it's, just a marketing gimmick to artificially pump prices.
Right, because on the surface, it really sounds like a gimmick. Hey, look, we have less money now, so we're richer.
It does sound like voodoo economics,
Oh, fine.
but to understand it, we actually have to step away from the blockchain for a second and look at traditional Wall Street.
Okay.
Think of it less like arson and more like a strategic tool. In finance, there's a very close cousin to this concept.
You're talking about share buybacks, right?
Exactly. This is the Wall Street version of burning money. You see it with the biggest companies on earth, Apple, big banks, major tech firms.
So when they have a ton of extra cash, they go into the market and just buy up their own stock.
They do. They buy their own shares back from investors.
I've always understood that as a way to boost the stock price, but I've never really dug into the math of why it works.
Okay, think of a company like a pizza. The company's total value is the whole pie. The shares are the slices.
Makes sense.
If you buy back shares and retire them, effectively throwing them in the trash, you're reducing the total number of slices.
But the size of the pie, the company's actual profit, hasn't changed.
Correct. The pie is the same size, but now it's cut into, say, 8 slices instead of 12.
Which means every remaining slice is physically larger.
Precisely. If I own a share, my claim on the company's profit, the earnings per share, goes up simply because there are fewer shares to divide that profit by.
Okay, that clicks. So by deleting some shares, the ones I'm holding become more valuable because I own a slightly bigger percentage of the company.
That's it. Token burning is the crypto equivalent of that, but often way more aggressive and transparent. It's the permanent removal of coins from the circulating supply.
Let's stick on that phrase, permanent removal. If I burn that $100 bill, I have a pile of ash as proof. But this is digital. You can't exactly incinerate software. So how does a burn actually happen? Do they just hit delete?
It's not quite that simple. Remember, a blockchain is an immutable ledger. The whole point is that you can't delete history.
Right.
If a token was minted, the record of its creation exists forever. You can't just erase it.
So where does it go?
You have to send it to a place it can never return from. We call this a frozen address, or sometimes, and I love this name, an eater address.
An eater address. That sounds incredibly ominous, like a digital black hole.
That is the perfect analogy. It is a digital black hole. See, every wallet address on a blockchain has a public address and a private key.
The public one is where people send you money. The private one is your password to get it out.
Right. Not your keys, not your coins. Well, a bond address is a special type of wallet. It's a one-way street because it has no known private key.
But how do we know nobody has the key? Couldn't someone be hiding it?
That's where the math comes in. Usually, these burn addresses are patterns that are statistically impossible to generate a key for. Like on Ethereum, the main burn address is just a string of zeros. 0000000, and so on.
Okay.
The probability of someone randomly generating the specific private key that unlocks that address is so infinitesimally small, it's basically zero. It would take longer than the age of the universe.
So once the tokens are sent there,
They are trapped, mathematically locked away, forever. And the beauty of the blockchain is the transparency. Unlike a corporate buyback, which happens behind closed doors, you can go to a blockchain explorer, type in that burn address, and watch the tokens entering the black hole in real time.
that is wild. You could literally watch millions of dollars flowing into a trash can.
It's easy.
But wait, looking at this Chainalysis report, does this only happen on purpose? What if I lose my password? Is that considered burning?
That's a crucial distinction. Functionally, yes, we call that accidental burning. If you lose your private key or send money to the wrong address, those coins are also effectively burned. They're removed from circulation because they can never move again.
And according to the data here, that happens way more than I thought.
It's staggering. Chainalysis estimated that roughly 29% of all mined Bitcoin hasn't moved in 5 years or more.
29%. That's nearly a third of all Bitcoin.
Correct. Now, some of that is hardcore Ochadellers who just won't sell. But analysts believe a massive chunk of that is simply lost. Hard drives in landfills, forgotten passwords.
People passing away without leaving instructions.
Exactly. It's a huge amount of lost wealth. That is accidental burning on a massive scale.
Okay, let's pivot back to the intentional stuff, the strategic arson, if you will.
Yeah.
We have the mechanism, the black hole address, but let's get into the economics. Does burning actually make the price go up?
That's the million-dollar question. And it comes down to basic Econ 101, supply and demand. The theory is simple. If you reduce the supply, but demand stays the same.
The price has to go up to find equilibrium. Scarcity creates value.
I would say scarcity amplifies value. That's a key distinction. And if demand is falling, say in a bear market, burning can help soften the crash. It's a deflationary pressure.
Okay.
But there's a psychological piece to this too. The sources call it the double effect.
I saw that. It sounds like a feedback loop.
It is. Think about an investor. A project announces a big burn. That signals that the asset is deflationary. So it encourages people to HODL to hold on instead of selling.
Because they think the supply crunch will drive the price up later.
Right. So step one, investors hold. Fewer coins are for sale on the market. The liquid supply drops. Step two, the project then burns tokens, tightening the total supply even further.
So supply is dropping from the burn, and supply is dropping from people refusing to sell.
Exactly. This double tightening can create a feedback loop that pushes the price up, which then attracts new investors who see the green candle on the chart.
And I assume the miners are happy too, because the asset they're mining is suddenly worth more?
Generally, yes. It aligns everyone's incentives. It's a way of rewarding participants without just printing more money and causing inflation.
Okay, let's get into the how.
Yeah.
Because the research shows some pretty wild examples. It seems like they fall into two main buckets: manual burning and protocol-based burning.
Correct. Let's start with manual. This is the closest to that corporate buyback. The developers make a conscious human decision to burn tokens.
And sometimes they just destroy what they already have, right?
Yeah.
I'm looking at this case study on Stellar from 2019. It seems extreme.
Well, Stellar is a classic, a shock and awe burn. The Stellar Development Foundation decided basically overnight to burn over 55 billion XLM tokens.
55 billion.
It was over 50% of their total supply. Imagine a company destroying half its inventory. They also removed the inflation function from the protocol. One move.
That's a bold way to signal commitment to scarcity. But manual burning isn't always a masterstroke, right? Sometimes it's more like a panic move.
Unfortunately, yes. We have to talk about the oops moments.
I love a good tech oops moment. Tell me about the Tether incident.
So this was July 2019. Tether, the stablecoin that's supposed to be pegged 1-to-1 with the dollar, accidentally minted 5 billion USDT tokens on the Tron blockchain.
They accidentally printed $5 billion. How does that even happen?
It was basically a clerical error. They got the decimals wrong. Suddenly, $5 billion of unbacked tokens existed.
That's terrifying. If that hit the market, Tether would crash.
It would have depegged the currency and probably caused a massive market crash. So what did they do?
They had to burn it.
Immediately, they sent it all to the black hole. It shows burning can be an emergency brake just as much as a gas pedal.
Okay, so that's manual. Someone pushes a button. But what about when the code does it automatically? That seems more futuristic.
That's protocol-based burning, and it's where the industry is heading. It's less about trust, more about math. The biggest example is Ethereum.
Second biggest crypto out there.
Yeah.
And this changed recently, right?
Right. With the London hard fork, they implemented something called EIP 1Fee59.
Catchy name.
I know, terrible branding, but brilliant mechanics. Before, transaction fees went to miners. Now, a portion of every single fee, the base fee, is automatically burned.
So every time I buy an NFT or swap a token on Ethereum, a little bit of ETH just disappears from the universe.
Exactly. And because Ethereum is so busy, the numbers are huge. There are times when the rate of burning is actually higher than the rate of new ETH being created.
The supply is actually shrinking.
Yes. We're talking about roughly $500,000 worth of ETH being burned every single hour during peak times. The network becomes a deflationary engine.
That's mind-blowing. The more people use the network, the scarcer the asset becomes.
And it's not just Ethereum. Ripple does something similar, but for a different reason.
Right, for security, to prevent spam.
Exactly. A common way to attack a network is to flood it with millions of fake transactions to clog it up.
A DDoS attack.
To prevent that, Ripple charges a tiny fee for every transaction. But that fee doesn't go to anyone. It gets burned. So for you or me, it's nothing. But if you try to spam the network with 10 million transactions,
It starts to get very expensive very fast. You're literally burning your own money to attack the network.
Exactly. It makes the attack economically unfeasible.
That's clever.
Yeah.
There's one more automated one that stood out to me. Swissborg's Protect and Burn.
Ah, yes. This is a fascinating evolution. So they take 20% of their profits and put them in a reserve. But they don't just burn blindly.
They wait for the right moment.
They watch the price. If their token's price is bearish, if it's dropping below its 20-day moving average, then they deploy that reserve to buy back and burn tokens.
So they only burn when the price needs support.
Right. It's designed to prop up the price when it's weak, to
Right.
maximize the impact.
Okay, so there are different models here. We talked about protocols, but what about the big exchanges, like Binance?
The exchange model is huge. Look at Binance with BNB or OKEx with OKB. These are centralized companies, and they usually burn on a set schedule, like quarterly.
They have a goal, right?
Yes, Binance's stated goal is to burn BNB until only half of the original supply is left. They're systematically cutting the supply in half over time.
And these are not small amounts.
Not at all. In March 2024, OKEx destroyed about $744 million worth of their token.
$750 million. Gone.
Hmm.
Now, what about the community model? I see Shiba Inu here. This feels less Wall Street and more internet culture.
SEB is where burning becomes a cultural phenomenon. They started with a quadrillion token, so the price per token was microscopic. Burning became a strategy to look more serious.
And the community's involved.
Oh, yeah. There are burn parties where users voluntarily send their own SEB to a dead wallet. Millions are burned daily. It's almost gamified, part of the narrative.
Okay, one more type here that seems really technical. Proof of burn. This isn't just about supply, right? This is a way to run the whole blockchain.
Yes, this is the most complex one. We know proof of work, like Bitcoin. We know proof of stake, where you lock up coins.
Right.
Proof of burn is a third way. It's a consensus mechanism. To get the right to mine the next block, miners have to literally burn their own coins.
Wait, so they burn coins to get the chance to earn coins. That sounds circular.
It sounds paradoxical, doesn't it? But think of it like buying a virtual mining rig. In proof of burn, you destroy coins. That destruction proves you have skin in the game. The more you burn, the better your chance of mining the next block.
And unlike proof of stake, where I get my locked coins back,
In proof of burn, those coins are gone forever. It's a one-way investment. It secures the network without the massive energy use of Bitcoin.
that is fascinating. Okay, we've painted a pretty rosy picture. It sounds great, but there has to be a catch. I'm seeing some skepticism in these reports.
You know me. I always look for the downside. And there are some significant risks, starting with the trust issue.
This goes back to the manual burns.
Exactly. When it's not automated by the protocol, you are operating on trust. What if the team just decides to stop? Or what if they manipulate the timing of a burn to benefit themselves?
Insider trading. Hey, we're announcing a burn tomorrow. Buy now.
For sure. And then there's a deeper, almost philosophical problem, the absence of possession.
What's that?
It's a cryptographic problem. I
Yep.
can prove to you mathematically that I have a private key, but it's practically impossible for me to prove that I don't have a key.
Oh, I see where you're going.
So when a project says, we sent these to a burn address, we trust them. But can we be 100% mathematically certain that nobody has the key to that random address stashed away somewhere?
Not really. So that black hole might actually have a back door.
It's unlikely with the standard all-zero addresses, but with others, it's a trust issue. And this reliance on, trust me, bro, economics, really rubs some people the wrong way.
Who are the big dissenters here? Who hates burning?
The most vocal is probably Charles Hoskinson, the founder of Cardano.
Big name. What's his take?
He's vehemently against it. He has rejected burning for ADA, despite huge community pressure. He has this great quote where he compares it to stealing food.
Stealing food. That's harsh.
His argument is, you want us to destroy the ecosystem's resources just so you can make a quick profit? He sees it as artificial manipulation.
I guess his point is that if the technology is good, you shouldn't need gimmicks.
Exactly. He argues that utility is king. If the token has no use, making it scarce doesn't make it valuable.
That's a really strong counter-argument. It's easy to get caught up in the hype and forget to ask, what does this thing actually do?
Right. It brings us back to that illusion of value. Deflation is attractive when prices are rising. But if the project has no real-world use, no amount of burning is going to save it.
So let's bring this all home. What's the big takeaway for our listener today?
I think the main thing is to see token burning for what it is. It's not magic. It's a tool. It's a mechanism for deflation used by giants like Ethereum and Binance.
But it's not a silver bullet.
No. For the learner out there, the insight is this. A deflationary mechanism is a great amplifier of value, but it is not the source of value.
I like that. It amplifies but doesn't create.
Exactly. You have to look past the smoke, pun intended. Is the burning supporting a thriving ecosystem like Ethereum? Or is it just happening to pump a chart for a project with no future?
Utility versus artificial scarcity.
And I'll leave you with this final thought to chew on. Imagine I create 10 gold coins. I own all of them. I melt 9 of them down, leaving only 1. It is now the rarest coin in the world.
Technically true.
But if nobody in the world actually wants or needs that last coin, is it worth anything?
Utility without demand is just...
Loneliness. Utility beats scarcity every time.
On that note, we're going to wrap it up. Thanks for listening to the Deep Dive. Keep your keys safe, don't burn your wallet by accident, and we'll see you next time.